Welcome to the Holistic Accountant Podcast. This is where we cut through conventional accounting and show you how a genuinely holistic approach drives better after-tax outcomes. It's not about ticking boxes or churning out tax returns. It's about strategic advice that builds lasting wealth. If you find this episode valuable, leave a rating and share it with someone who will benefit. Okay, today, Mena and I want to talk about owning your business premise, whether that's a retail shop or an office somewhere, whatever it might be. You know, sometimes business owners think it's a smart move to go and buy the premises where they operate their business from. And today we just want to work through that. You know, quite often people feel like rent money is dead money. I mean, that's true that, that saying is used often, particularly with homes, own and occupy homes. And sometimes businesses, business owners take the same sort of approach to business, which isn't always the right thing to do. And there's, pros and cons, and we've got to really take a really deliberate and educated approach. And this is something that your holistic accountant should be able to help you with, but it's a really, really important decision. And, going and buying your business premise isn't necessarily the right move.
So I think the first thing to do is to really separate them into two separate transactions. You got to understand that your trading business is separate to your property business. So they're two different transactions with two different risk profiles and two different merits as to whether you should take them on or not. And you would also have them in separate entities. Mixing them sort of clouds your decision making because people think, oh, I'm just going to get the rent and it's all just going to go into the same entity. But it creates really an asset protection risk because if actually something was to happen to your business, which would have a sort of trading liability, it can affect then the property that is also within the same entity. So it's really important to position the two prospects separately. If you think about McDonald's as an example, they own the freehold and they lease it back to the franchisee. And what it is, people say that McDonald's is really a real estate business because all they're doing is they've got a location that has a lot of goodwill around it where their franchisee is paying them the rent on it as well as royalties. So they're gaining on two fronts. And in those instances, it really makes a lot of sense for those types of places where there's goodwill attached to the location that you would actually buy the freehold and have it, and it would yield a high sort of rent for you annually.
That's right, Mena, and you've got to really ask yourself, what sort of business are you in? I mean, McDonald's is a great example because they've got that reoccurring revenue, royalties or rent, and they've got the hard asset. So that's why people say they're mostly a real estate business than a fast food business. And it's kind of true because their profit and loss statement will look more like a real estate business than a retail business. And so you've got to ask yourself the same question, are you in the property business? Does that appeal to you? Does it appeal to your risk profile? Is it the right thing to do? And by approaching this decision, recognizing that it's completely separate, or it should be completely separate from your business, really gives you a better perspective, because what it does is it forces the property acquisition to work on its own merits rather than muddling up, some benefits that might be perceived by you in your business that may or may not be factual, of course. Now, the first thing to really think about is flexibility versus commitment. I guess as a tenant in a building, you've got a little bit of flexibility. I mean, depending on your lease terms, of course. But, if the location doesn't work for you anymore, you can just pick up your bongos and move to a different location. Whereas as an owner, you have to some degree, less flexibility, of course. It's going to be more costly. You'd have to sell the property and then go and buy a replacement property. There's obviously costs associated with doing that. It's going to tie up capital. If you're going to borrow to buy that property, obviously then it gives rise to, greater commitments, financial commitments, loans, and so forth. But the flip side is that if you're going to spend a lot of money on a fit out, or if you do build goodwill in that location, I guess from that perspective, you can own that goodwill, you can own that location. And similarly, if you're going to spend a lot of money on a fit out, you don't want to be in a situation where the landlord decides not to renew the lease to you. And then, you're going to have to write that fit off out and find another place to operate your business from. So as you can see, it's quite nuanced, and it's going to really depend on the individual business and the owner's individual circumstances also. I mean, if you've already, got a lot of gearing separate to your business. So, for example, common one someone would be owning investment properties, then adding more gearing firstly might not be doable from a borrowing capacity perspective or serviceability perspective, but also it might not be appropriate as well. So you can see here there's no one size fits all. It's really about understanding the pros and cons for your situation and then looking at it on a property basis, like a single holding property business sort of decision. And then also still coming back with the broader lens and saying, well, what are the advantages across the board to your business, to you personally, and as I said, just as a standalone transaction.
Okay, so let's really start talking about the structure or how to structure the property acquisition. And what I'd like to first say is that, like, if you don't actually structure it right correctly, then unwinding it can be costly because unwinding it, changing the structure will result in a CGT liability in addition to stamp duty. So it's really important to get this decision right from the get-go. And probably the main structure I really want to focus on is the one that's really most talked about, and that's around self-managed super funds. A lot of people like to buy their business premises in a self-managed super fund because they think it's a good retirement asset. Even if I sell the business, I can yield the return. I've established goodwill at the location and so forth. And in a lot of instances, it does make sense, but in some, it doesn't. However, when it comes to the self-managed super funds, you really need to be wary that there's certain contribution limits in place inside super. So you might not have the necessary capital or be able to get the necessary capital in a self-managed super fund environment to fund the acquisition. In addition to that, in retirement phase, if all your super is actually held within that property itself, then you've got a liquidation problem because in retirement, you got to pay yourself a minimum pension. That minimum pension is based on a percentage of what the super fund is actually worth. Now, if the rent is not yielding enough cash to actually fund or pay that minimum pension out based on the property value, then that means that that fund can't be in pension phase and you might actually be forced to sell the property to realize your cash. So it's really important to understand whether a self-managed super fund is actually the right vehicle to buy the assets in. Further to that, now the self-managed super funds also have their own complexities around and the need to prepare annual sets of financial accounts and also needs to be audited by a third party each year. In addition to this, you might need to take up separate insurance policies that you might otherwise have in an industry fund. So life insurance, income protection, TPD and so forth, which tend to be a lot more expensive when they are in sort of industry fund environments, albeit a better policy, but a lot more expensive. So it's really important to weigh up all these options before considering a self-managed super fund. Finally, around the audit provisions around self-managed super funds or in any arrangement, you really need to have the rent priced like what an external landlord would have it priced at. So you can't under or overstate the rent. There's a common sort of theory that, if the super fund environment is only paying 15% tax, why don't I pay the super fund higher rent than what the market rate is, just so I can get more money into a tax effective environment and get the deduction in my sort of personal name or in a business where I'm paying 25, 30 or 40% tax. Now, it's all well and good in theory, but the problem is all these need to be documented at market rates and that you need to have a third party sign off. And sometimes an auditor will actually ask for an independent review of that lease agreement. So it's really important that you have all these agreements in place and understand the complexities involved of acquiring your business premises.
So, in addition to the structuring, we need to think about concentration risk. And concentration risk can occur both from a financial perspective and also from a business perspective. So, let's talk about financial concentration risk. Of course, if we're going to buy a property, any property in Australia is going to cost a lot of money. So, we're talking about a large sum of money. And we want to really think about how is that going to work for us financially? Like, can we afford the commitment? Of course, not always, but mostly the loan repayments are probably going to be similar to what you're paying in rent, or, there can be in situations that they could be more. So you want to really think about the affordability of that. Then you want to think about the performance of the property itself. So how will its value change over time? Because if you're going to put a lot of capital into this asset, and for example, its value doesn't change, and not all properties rise in value, of course, that's misnomer. I mean, a lot of residential ones do, but commercial can be a little bit different. So then you want to really think carefully about how that's going to work. And then also from a financial risk perspective, you want to think about, well, what happens if your business changes? So what happens if profitability declines? Or what happens if you need to pivot or change the business and you no longer need that premise anymore? Can you find another tenant? Like if you have a special purpose building, for example. So you're buying a restaurant. Well, of course, unless there's some major changes or improvements to the building, only another restaurant's going to move into that premise. So whereas if you've got a pretty vanilla retail shop, then it's possible that you've got a wider audience of potential future tenants. But you really want to ask yourself around how you can plan around those things. How much concentration risk is it creating? And, if you can buy a business with alternative uses, so if you don't use it for your business, can you at least put a tenant in and earn income? Then that also reduces your risk. The business concentration risk could be, things really related to that geography. So, if you own a business in a certain area and you're dependent on local traffic or people that live in close proximity to their area to service as customers, then you want to think about whether that's going to really serve you. And that can be a pro and a con, of course, if it's in a location that is well established and, with plenty of your sort of target audience, that's obviously going to be a positive. But if the location changes or, it's an unproven market, for instance, that's going to create some concentration risk as well. The final thing to think about is if you go and sell your business one day, what will you do? I mean, you could sell the business and then keep the premise and then rent the premise, obviously, to the new owner of that business. That's one option. Or you could sell the two together. That could be a little bit more challenging because obviously, you're going to need a purchaser with either someone that has a substantial borrowing capacity or substantial amount of capital or potentially both. So if your business has a lot of goodwill attached to the location or, there is a very expensive fit out, sometimes having or owning the property can be a positive and can make it a little bit easier to sell the business. But I would say generally, in most circumstances, it can be a little bit more complex. And we've certainly seen clients do that, but also in terms of like sell the business and then keep the business premise and just to enjoy the rental income stream, particularly if they're transitioning into retirement. The flip side to that, however, is that what happens if the person that buys your business doesn't do so well and they go out of business, then you're stuck, potentially finding another tenant. And what sort of level of vacancy will you have and how dependent are you? What assets do you have other than that to be able to rely upon if that situation occurred? So really thinking through like how does it help that your exit strategy or succession strategy is an important consideration also. So as you can see today, there's lots to think about. And as I said at the beginning, there's no one size that fits all. Every business is different. Every location is different. Commercial properties vary significantly as well. And how you put the transaction together can also be different for every circumstance as well. So it's certainly something that we would recommend you engage with your holistic accountant about and engage as soon as possible, really. Sometimes we'll get clients reaching out to us saying, I found this property on the weekend and now I think I want to buy it, before you've done the sort of analysis in the cold light of day to work out whether in fact that's a good decision. So that's really the starting point. Is it a good decision strategically, financially, and from a personal wealth perspective also? Attack that question first with the help of your holistic accountant. And then if it does have merit, then of course you can build out a plan on how to structure it in your particular circumstances, setting a budget and also identifying the characteristics that you need to and the outcomes that you need to achieve to make it a success. Okay, we'll leave it there for today. Until next week, bye for now.